Good afternoon, everyone.
Yes.
I think most people have filed in. Well, welcome to another edition of Tax Foundation's Talking Tax Reform series. Today, the panel is on considerations for the 116th Congress. The upcoming Congress will consider a multitude of tax policy questions, modifications to the Tax Cuts and Jobs Act, infrastructure, retirement account changes are expected to dominate the agenda. In addition, the next Congress will need to confront ever-increasing federal deficits and begin the conversation about making parts of the TCJA permanent, as first of the many provisions start expiring at the end of next year, and many are coming up in the following years. So today's panel, we have three great panelists here. I'm going to introduce each of them. Each will speak for about 5 to 10 minutes, and then after that, we'll open it up to questions. I may have some myself, but then I'll also, if the audience has a bunch, we'll get there as well. So, first speaker is going to be Nicole Kading. She's currently the Director of Federal Projects at the Tax Foundation. And as director, she researches on federal tax policy issues and leads a team of analysts. Her analysis has been featured in most major publications, such as the New York Times, Wall Street Journal. And she also dabbles a little bit in state tax policy, and she's well known throughout the United States, especially Arkansas. Second up is Rich Rubin. Rich Rubin is the U.S. tax policy reporter for the Wall Street Journal in Washington. He focuses on the intersection of taxes, politics, and economics. He was the journal's lead reporter on the development of the 2017 tax law and continues to cover its impact. And then following Rich is Kathy Pickering. Kathy Pickering is the executive director of the Tax Institute and vice president of regulatory affairs for H&R Block. With almost 20 years of experience in tax administration, Kathy is responsible for the strategic direction and management of the team of the nation's top tax experts. All right, so starting off, Nicole Kading, 10 minutes.
Thank you, Kyle, and thanks for everyone for being with us today. When we thought about this panel earlier in this week, we thought there might actually be a vote going on during this time, but it looks like that has been postponed, and I'll let Rich talk more about that because it's his reporting that alerted me to that. But there's obviously a lot of questions, I think, right now about what Congress is going to do over the next 2 years. Part of that, I think, is going to be defined by the next 10 days. What happens here in DC? How do they reach an agreement on government funding? Do they add in the farm bill and flood insurance and those questions? But they have several open tax questions to work through as well. The first being the extenders, this perennial debate we have on this 30 or so tax revisions that expire every year. Can they come to an agreement on reauthorizing those for the 2018 tax year? The second is the technical corrections to the Tax Cuts and Jobs Act. Chairman Brady has said he has a list of about 70 of these provisions that he'd like to work through. But the bill from this week has 5, and those are likely seen as the most important. The first one of that is the qualified improvement property provision. Due to a drafting error in the Tax Cuts and Jobs Act, some of the expensing provisions are not being applied correctly. And in fact, for this type of property, think of it like lighting and sinks and cabinets and the things that a retailer would put inside of its store, they're actually getting worse capital treatment than they did last year before tax reform. There's a few others. There's a question about when the changes to the net operating loss deduction, when did those actually take effect? They want to clarify that language. There's also some question about the way the IRS has handled refunds for multinationals that have deemed repatriation liability. But so they kind of have to work through those questions. And we'll see if they actually can get that done over the next week. I'm not optimistic that that will happen. But if you read the bill, you can see that they've made an attempt to add a lot of priorities, particularly from the Senate. There are some provisions involving retirement savings, which come directly from a bill co-sponsored by Finance Ranking Member Senator Wyden. There's a few other provisions that tend to have a bit more bipartisan support. They pulled out, for instance, the startup provision from Tax Reform 2.0, which is really the only provision that got bipartisan support back in September. They rolled that into here. So you can see they were trying to give some thought to this. But if they aren't successful, the questions then become, what does the next Congress do? I think there's a number of different things which Kyle alluded to, which we can talk a bit more in the Q&A. But some of the things that I'm in particular watching for next year is what happens in the House to the state and local taxes paid deduction. There's been a lot of conversation this year about that cap, and particularly the impact of that on more Democratic heavy districts in New York and California, Connecticut, DC, et cetera. In fact, when they had the Tax Reform 2.0 hearing earlier this year, the first amendment offered by Democrats was to lift that cap and to pay for it by raising the corporate income tax rate. And I think that's going to be a lot of the strategy we see from the House, is some tax provision paid for by raising the corporate income tax rate. But there could also be some areas of compromise or bipartisan work, I think. There's been a lot of discussion about these retirement provisions. It's something that incoming Ways and Means Chairman Representative Neal has talked a lot about, that he'd like to see done. Senator Wyden has talked about this. Infrastructure, I think, is one as well, that we could have a conversation next Congress about better funding infrastructure that both parties could work through. And then there was the president's comments about a middle income tax cut earlier this year, which I don't think any of us thought he had a real drawn out policy proposal at that moment. But you could imagine the president in particular working with some members of Congress developing some sort of middle income tax change. Particularly, I'm thinking about it in terms of something like changes to the earned income tax credit. You could see something like that perhaps moving through the next Congress. But there's then a large other list of things that I think we'll be discussing over the next couple years. As Kyle mentioned, we do have the first expiration in 2019. The alcohol excise tax provisions of the Tax Cuts and Jobs Act expire next year. Does Congress try to reauthorize that for 2 years or 5 years, or does this join the ever-growing extenders list? We've got some of these other conversations about the amortization of things like research and development or interest deductions, which in 2022 start to change dramatically. So perhaps this Congress starts to think through ways, or this upcoming Congress thinks through ways to modify those provisions in a way that's more acceptable to the business community. So with that, I'll pause and turn it over to Richard, and then I'll look forward to talking about more things in the Q&A.
Great. Thank you. I apologize in advance for my voice. It is not about half of what it usually is, so bear with me. So I just wanted to really give you sort of a quick overview of where we are in the lame duck session on taxes, which is changing as we speak, and then I'll kind of break the 2019 agenda into 3 buckets for you. In the lame duck, Chairman Brady has a package of tax bills about $55 billion. There's 5 pieces to it. There's extenders, which is a bunch of stuff that expired at the end of 2017 largely, which is, so they're just reviving it for 2018. So this is relatively urgent because, as Kathy will talk about, I'm sure people are going to file their returns soon, and both for individuals and businesses, knowing what to put on your 2018 return becomes a pressing question. That's 1. Tax assistance for disaster victims is 2. The retirement package is 3. IRS reforms is 4, and technical corrections is 5. A lot of those things do have bipartisan support, but there's really just not a lot of support for this package as it is right now. The House was thinking about having a vote today and didn't for a couple of reasons. One is there's a coal excise tax provision that's driving some concern among Republicans because it extends for 1 year a higher excise tax on coal. 2, this is House Republicans, especially those who are leaving, last chance to kind of get their pet project attached to a bill that's going to get a vote, and so everybody wants their own pony. Even if the Senate's going to come along and cut the pony in half. They just don't want it. And then third, you've got attendance issues. There are, members who have lost their seats are not particularly inclined to show up in December and November, so that makes the margin of Republicans have even smaller than it might be otherwise. Now, on top of that, Senate Democrats are saying, well, wait a minute, like, why would we advance this bill? You need 9 of us at least. Why would we advance this bill now when we're going to get to have the House majority in January and we'll be able to shape it more to our liking? Some of the things in there they're perfectly fine with, but the biggest thing, I think the biggest sticking point is really on the technical corrections. The Democratic position has largely been, okay, come on. Republicans pushed through this tax bill really quickly in 2017. It was completely partisan. Like, oh, now you're finding mistakes in it. Like, come on, we're not going to help you for free. There's going to be a price. And so that's, I think it's sort of a segue to where we'll head next year, because that question of what's the price for fixing things is going to come back up and up again. So let me break 2019 for you into those 3 buckets. The first, which is not really about tax reform or legislation so much, is the House Democrats' attempt to get the president's tax returns. I'm happy to walk through all of that for you if anyone has questions about it, but I mention it only because it's a thing that will consume time, energy, political capital of the same members who are going to be writing the tax legislation. So even if that isn't itself legislative, it's something that's going to occupy some agenda time. The second bucket is messaging, right? We're, at the end of, so I'm stealing this line, but, it's sort of, we turn right from 2018 to 2020. And so that means that Democrats are going to pass things that try and give voters and some sense of where Democrats would take the country if and when they had the House, the Senate, and the White House as they want to have in 2021. So you may see bills that raise the corporate rate, that send the estate tax exclusion back to where it was, that raise the top individual tax rate, that do something on the state and local deduction, all the things they didn't like about last year's tax law that are big picture things. You'll see that the president almost certainly wouldn't sign, and that the Republican Senate almost certainly wouldn't do. You may see House Democrats advance those things as a way of kind of testing out where the public is, where their members are, and then to some extent echoing where their potential and actual presidential candidates are. And so there'll be a lot of noise about that. And the general thing to watch for is if there's something that it sure seems like the president wouldn't sign that and it's a core piece of last year's tax law, just put that in the messaging bucket. But the third bucket is really things that are enactable, and I wouldn't discount the fact that things might happen. There are the technical corrections, and then there are non-technical corrections. You saw one in Chairman Brady's amendment to his bill this week, where he repealed a provision that increased the unrelated business income tax on nonprofits that provide transportation and parking benefits to their employees. Like, this matters a lot to churches and nonprofits. They've been really upset about it. And it has a score attached to it. And so you may see things like that where Democrats have some hearings. Chairman Neal's talked a lot about having a bunch of hearings. And they'll come up with things that they want to change. And there's going to be a price for that. And the model to really think about is, there's 2 models to think about. One is what's known as the grain glitch, which we all dealt with 8 or 9 months ago, which was a problem in the tax law that advantaged cooperatives in farm country over grain elevators and other businesses run by non-cooperatives, by pastors or corporations. And that was a real problem because it was threatening to really change the wheat market in the Great Plains pretty dramatically. And Democrats actually wanted to fix it because Democrats represent many of the businesses that were concerned about it too. So it wasn't like something that only Republicans wanted to fix. So Democrats wanted to fix, but they wanted a price, and they got one, which was an expansion of the low-income housing tax credit. So you might see that kind of thing again. Democrats will have a list of things they want, and the list has to be things that Republicans can accept. So a higher corporate rate is not that, but you can imagine. I don't know where they're going to land, but you can imagine things on the child credit, the low-income housing credit, the EITC, that Democrats might think about asking for in exchange for fixes, both technical and non-technical. And then the second model, I'd note that we're now, Israeli is 2007. For those of us who were here at the time, you had a Democratic House and a Republican president. You had a Democratic Senate, but you had then ranking member and now Chairman Grassley in charge of the Finance Committee Republicans. And Chairman Grassley was, he'll push back on things, but he's willing to do offsets on that increased tax compliance, that look at reduced tax avoidance. So I would look at that as a model, some of the things that passed and were debated in 2007, not those exact policies, but the concepts that were happening in 2007, kind of before the economy turned south and everyone said we're not doing offsets anymore, we have to switch to stimulus. So that's kind of a high level overview of where we'll head, but I'm happy to take questions when we get there. Okay.
Thanks. That's so interesting to hear Richard's perspective on the dynamics at play. What I can do is talk about what we know is and isn't happening. So I'm going to discuss the three things that we're watching closely during the lame duck and the start of the filing season and its impact on the individual taxpayer. So the three things that we're watching are the start of the filing season and some of the pending challenges, tax reform and withholding specifically, did taxpayers get it right, and then the state follow-on impacts. So first and foremost, the start of this season feels a lot like a repeat of the start of last filing season, or in the words of Yogi Berra, it's like deja vu all over again. First with the expired extenders. If you remember, last year the Bipartisan Budget Act, well, it wasn't last year, it was this year, was passed in February, and filing season had already started. So updating processing systems after returns have already begun is really tricky. And many taxpayers, believe it or not, had already filed their tax returns. So they either just plain missed out on the benefits, or they had to figure out that they missed a provision that was now updated and file an amendment. There were 3 or 4 provisions that were on our watch list specifically. That was the PMI, the private mortgage insurance deduction, the tuition and fees deduction, and then cancellation of debt on foreclosure for primary residents. So just to illustrate this impact, for a taxpayer who lost their home due to a foreclosure, they're already in financial distress. To then file your taxes and find out that that forgiven debt is taxable is a shocker. And then, if they're already financially stressed, trying to find out how to come up with that money in order to pay those taxes, really, really tough. So ultimately, the extender was passed, and all that stress could have been avoided. The second thing is federal disasters. We'll recall that last year, late into the fall, we were still dealing with the hurricanes and the California wildfires. And so in the Bipartisan Budget Act, there were some additional disaster provisions that were really intended to be helpful. So in general, there are just only so many things that you can do in the tax code to help with disasters, right? There's the extensions on deadlines for filing and payments, penalty abatements, things like that. So in the legislation that was passed in February, there was also some other things like this EITC, ACTC look-back election. And just to kind of go through that, what that was intended to say was, if somebody lost their job such that now they didn't make enough money to qualify for earned income tax credit, they could look back to the prior year's income in order to be able to claim the EITC. So certainly a very, beneficial assistance for those that were impacted by it, but because it got passed so late And, people that were impacted by the wildfires had moved out of their homes, had difficulty getting their prior year taxes. It became very difficult for people to know that that was eligible for them, take advantage of it, and benefit from it. So all of this adds up to the fact that late legislation, which is often intended to benefit taxpayers, can miss the mark. The late changes result in a delayed start to the filing season, delayed implementation of the intended tax provisions, and taxpayers missing out on the benefits that were intended for them. The second thing we're looking at is the tax reform withholding. So here's my question for everybody. How many of you know the difference between the W-2, the W-4, and the WD-40? So we ran a survey. We're about to publish the results, and we were having a little bit of fun with it. But what we really wanted to understand is, do consumers understand the impact of the withholdings? Have they taken action to mitigate that? And and what we found was very telling. Basically, consumers aren't sure what they've done, and they really don't know if they got it right. 40% said they updated their W-2. Well, we know the W-2 is the income statement that your employer sends to you, so that was wrong. 19% said they updated their W-4. So that's the right answer, but that's pretty telling. 19% of general pop updated the W-4. 17% said they updated their insurance documents, which that's interesting. And basically 22% said other, which means they didn't do anything. So the other thing that was that, the survey respondents said that they're expecting bigger refunds. So we're very anxious to see how this really manifests in the filing season, where people are coming in expecting bigger refunds, don't understand withholdings, and haven't taken appropriate action to get the right answer there. What we know for sure is that the best time to update the W-4 is in conjunction with your filing. This is when taxpayers have all the information they need in front of them, they're working with their tax advisor, and if they got a refund surprise, they're highly motivated to take action and make the changes right then. With a new W-4 in the works, it means it's not available yet. If it comes out after tax season, the awareness and the take-up on it are going to be really low, and the incentive to take action won't be there. Finally, we're also following the state follow-on impacts. So while this isn't talked a lot about in the context of federal tax reform, the way that state income taxes do or don't follow federal may become an issue for your constituents when they file their taxes and see those results. At a very high level, states generally start with either federal AGI or taxable income. Because of the changes at the federal level, specifically the increase in the standard deduction and the elimination of exemptions, the state starting point will change. Where some states have, done nothing following the TCJA and just let things follow through on conformity, it's likely that most states will see an increase in state income taxes. A few states have made modifications to the tax rates, like Missouri lowered its top rate for individuals, and Idaho put in a cut across all individual brackets. But these are likely to crop up as questions and confusion for taxpayers as they look at their total tax situation, not just their federal income taxes. So in summary, the things that we're watching: start of the filing season, whether extenders and disaster legislation get passed, the refund surprise and helping folks get their withholdings updated properly, and then the state follow-on impacts. So to say another yogiism, the future ain't what it used to be, and so too with taxes.
Thank you very much. So before I open it up for questions, I have a few of my own, and one theme that I think that Nicole and Rich have sort of picked up on here is that there's potential for some bipartisan agreement on some policies that could end up on Trump's desk and he may sign it. But there's a price to pay for those things that Democrats, in order to sign on to anything that Republicans like, are going to want to ask for something. one thing that pops up that I haven't heard very much about, didn't hear about, is infrastructure. And I'd like either Nicole or Rich to talk a little bit about, what are the prospects for an infrastructure bill, what might that look like, and does it have any chance over the next couple of years?
I start with the premise that the numbers that you hear are large if they're going to carry if they're going to be fully offset. So like you hear people talk about $1 trillion infrastructure bill. If Congress is looking for $1 trillion to pay for that, I have a hard time seeing where the two parties can agree on that. It doesn't mean it can't happen or won't happen, but if that's the starting point of fully paid for $1 trillion bill, I'm pretty dubious.
Yeah, I think the one thing I would add is you could imagine $1 trillion bill that's perhaps paid for in terms of spending or bonding, which is something that they've done a bit of in the last several times the surface bill has come up. So you could maybe see there being a conversation about a little bit of a tax increase someplace. I mean, there continues to be this question on the gas tax in terms of how many senators, if you actually put it on the floor, would vote for a gas tax increase. I think that number is larger than most people think it is. But it's a question of getting it to the floor. I have no question that if you put a gas tax increase on the president's desk and gave him $1 trillion in new infrastructure spending, he'd sign that any day of the week. But you could imagine some sort of conversation about maybe some small changes here, and then we add some bonding to it. And that, again, I think is the one area where you could see some conversation next year of something that could get done. I still think it's not likely. I think any of these things we're talking about where there could be a bipartisan agreement is still less likely than not to happen.
Well, and right, and the thing I always try to keep in mind is like Congress likes deadlines, and there's no, other than the fact that infrastructure is not as good as it could be, there's no real deadline for it. There's nothing that expires. There's nothing that happens if they don't pass something. So that tends to just start you from the premise of things won't happen because there's no reason to make them happen.
One question for Kathy, actually, that I thought of while you were presenting here. So, talked a lot about challenges with filing this year and withholding and potentially next year. But a main feature of the Tax Cuts and Jobs Act is just really not that stable. There's a lot of things that are going to change over the next couple of years. Do you see that these sorts of challenges increase over the next decade, or do you think people are going to be able to figure this stuff out?
I think that in general, what we see is that the individual taxpayer thinks about taxes at filing time, and then takes a lot of their information from the headlines. So while people are very much aware that there's been tax reform, having then taken that analysis to what does this mean to me and how am I going to benefit from it, people tend to be a little bit less informed and understanding the implications of that. So the more volatile the changes are, I think the more difficult it becomes for the individual taxpayer to really take advantage of the benefits.
So another thing that came out this week, I don't know, perhaps you mentioned it briefly, but a lot of lawmakers are starting to think a little bit about GILTI, and especially Democrats. Do you see that any potential changes there or in the international regime? Do you think Republicans would give up something there?
So for those of you who haven't followed all the acronyms, GILTI is I almost got this wrong in the story this week. It's the Global Intangible Low Tax Income Tax. And that's basically the new minimum tax on foreign income from column tax havens or low tax countries. And there are some both structural issues with it. Generally, Democrats are concerned that even though that it provides an incentive for companies to shift profits and jobs abroad, because in some cases the rates on foreign earnings are lower than the rates on domestic earnings. but then companies have some issues too because of the way that the GILTI provision interacts with pre-existing foreign tax credit rules means that companies aren't getting the benefits they thought they would get when they're operating in high tax foreign countries. So that sort of, in some ways, you could see that as like the potential ingredients for some sort of discussions about it, because there are things that companies want and there are things that Democrats want. Those two, of course, are cutting in opposite directions. But one could I expect there to be a fair amount of talk about it. That's one of the things I'm sure Chairman Neal will have some hearings on. And so I don't see that that's something that moves quickly, but the more there are real world consequences for companies from the way the system as written is working, the more everybody will be incentivized to come to the table to like fix any problems that they're seeing.
The one other thing we haven't really talked about yet, given that this is a conversation mostly about Congress, but there will be a number of presidential candidates talking about taxes over the next 2 years. And so I think of GILTI as being one of those things that maybe gets discussed in that context, right? You could see reforms, modifications, repeal, and restructuring of GILTI being a cornerstone of a Democratic presidential candidate's tax plan. Particularly along these lines, I think we saw Senator Brown from Ohio this week kind of start in that direction. And so I think that will be part of it. And I think that broader conversation about the presidential candidates is going to take much of the oxygen out of this room and this building. I think we will see, there could be 15 or 20 people running for the Democratic nomination, all of them with their different version of what tax reform should look like in 2021. And so I think that while there's some of these areas for agreement on the smaller issues, the bigger conceptual questions will likely be left more to the political campaign space and a little less to the committees. So I think you could see that conversation. You could imagine a Senator Warren having a flank of her tax plan talking about GILTI, for instance.
And I would just add to that each of the past 4 presidents has talked a lot about taxes on the campaign trail, and then come in and in their basically their first year, in their first year done a lot of it. Obama did some of it in 2013, but so don't, if you see 15 or 20 different plans out there, it's tempting to just like shut them out, but that framing actually will really drive where things will go, because we've seen that. We saw that in 93 and 01 and 09 and 13 and 17, that where the winning presidential candidate starts is really the starting point for their majority in Congress.
So with that, I'd like to open it up to questions from the audience. Yeah.
Hi, Scott Hodge with the Tax Foundation. Thanks for being here. One of the issues that you haven't addressed is carbon tax. And, that's always sort of percolating in the background, especially among academics who see it as a solution for both climate change, but also, raising revenue. But there's also been some talk that because of the election results, especially in Washington State and elsewhere, that maybe there isn't a lot of momentum for that. How do you see that sort of playing out politically?
I put that right in the same category that Nicole put GILTI into, which is that I would expect to see Democratic presidential candidates try and figure out what their message and policy looks like on that, and on climate change and on taxes. And I imagine some of them will propose something that will look either actually be a carbon tax or look a lot like it. And so we don't have a lot of clarity into that yet, but I think you'll see action on the House in terms of hearings and drafts and proposals. We'll see if they actually vote on something, and you'll see action in terms of presidential candidates. But for enactment, I would imagine that's kind of a 2021 vision thing, and so it's worth watching in that dimension for sure.
And I think a lot has been made about Representative Curbelo losing his seat after proposing a carbon tax. I don't see the connection between the two, quite frankly. I think much of this conversation that he lost because he proposed a carbon tax is misguided. I think it's people trying to claim victory for something that they didn't really influence. I think it's much more of he was in a swing district in an election that did not go in the direction of his party. But I do think, again, it will be kind of this broader conceptual conversation. I don't see the 116th Congress enacting a carbon tax, but you could imagine a Congress in 2021, if Democrats kept the House, pick up the Senate, take the presidency, that Congress could be more open to enacting that sort of climate change legislation. The question, I think, much of it will be is interesting to watch is what are the offsets that folks pair with it? Do they decide to just do a increase and create a carbon tax? Do they decide to go with this approach that was introduced this week with some sort of dividend directly to individuals to offset some of the regressivity? Do they pair it with some sort of lowering of the corporate income tax rate? Do they find some other way to pair it? I think that actually will be the more interesting part of this conversation. It will be a conversation in the next 2 years. But how do people look at providing offsets to mitigate what are perceived to be some of the deficiencies of the tax?
Speaking of Republicans and carbon taxes, do you see a world in which you get to the mid-2020s and they're thinking about making permanent the individual provisions? Do you see carbon tax being on the table for that or something else, or do they just eat the cost again?
So Rich kind of made this point a little bit ago, but you talk about the infrastructure context, you're looking for new revenue. There's only so many places that it can come from at this point. Obviously, we look at what CBO is telling us about the federal budget deficit. We get to 2025, we've got $1.5 trillion annual deficits. That's assuming the Tax Cuts and Jobs Act expires. We've got questions about then all of the pressures that these entitlement programs are putting on there. But if you're looking for new sources of revenue, there's not a lot of them, right? You're looking at a carbon tax, you're looking at something like a value-added tax, and then you're just changing a lot of the other taxes we have. So I think that if there does become a actual concrete conversation, 6 years from now about fixing the deficit, then yes, that has to be part of it because the math doesn't really work otherwise. The question is, do we actually have a conversation in the mid-2020s about the deficit? That's not clear to me yet that we will.
Any other questions? Yes.
I'll just say, well, one of the things that wasn't changed very much in the Taxes and Jobs Act was the capital gains tax, except for the economic opportunity zones. So do you think that there are going to be new developments with the economic opportunity zones, or that there's going to be an increase in the capital gains tax?
So let me take the second question first. I think Democrats will absolutely propose capital gains tax increases in two forms. One is the rate, and the other is repealing what's known as the step-up in basis at death, which basically says that if you die with unrealized gains, that your heirs inherit those at the basis at the time of death. So imagine people who have stock they've held since the 1950s, and they die, and they either are or aren't subject to the estate tax, but then their heirs sell the tax on the next day, and all those potential capital gains taxes go away. So Democrats have talked about that. President Obama had some proposals on that. You will hear Democrats talking about that again. Opportunity zones are really, I think your first question, are really fascinating. This is, again, if you're not familiar with it, it's a provision that's in the tax law that says you can take unrealized gains, take actual realized gains, sell assets and defer your capital gains taxes to the end of 2026, plus get additional discounts and future exclusions of gains if you invest those proceeds in one of 9,000-ish low-income opportunity zones around the country. Every tax lawyer, accountant, rich person is really excited about this. I cannot tell you the number of people who are spending a lot of their time obsessing about finding opportunity zone projects and investments right now. So that's a separate question from whether it's actually going to achieve the intended policy benefits, but it's generating a lot of attention. So I would expect, again, to go back to what I've said a few times, that Ways and Means Committee to look at how well that is or isn't working, and as we start seeing some data coming out of that program, you might see some changes around the edges on that if it's either proving not popular enough or too popular.
I got a question regarding our energy zone. And my question is as follows. As you well know, is that they came out with the legislation, and it was like last week of December. And they just recently, the last week of October, came out with the rules by which they play the game. You know, you got this 180-day, rule right there. You know, there's some people who actually, cashed in their games, let's say in January. I mean, if you count, and the clock started running, let's say I cashed in my game on January 2nd. The 180-day clock started running on, January 2nd. So, it doesn't take, much, understanding the math to know that, the 180 days came before the rules. So would they compromise, on that 180-day rule in lieu of the fact that, it took them so long to come up with the rules by which they play the game?
So let me preface this by saying that I am not a tax lawyer. You're actually standing right next to a very good TCJA. Again, I can't recommend you hire him or not, but
you understand my question.
I understand your question, and I think it's certainly, you can imagine issues where people, for a variety of reasons, sort of wanted to or felt they had to sell. As best I know, again, not providing tax advice, if you didn't put it into a fund in 180 days, you're out of luck.
And my second question is that the rules, the provisional rules, or the draft that they've come out with, they speak to, original use, but they're supposed to come out later with some language on, the other substantive use. To this day, have they, it all came out with anything, defining what substantive use is?
I don't think so, but I know they are working on a second regulatory package on this, and so the Treasury staff is well aware of the market desire to get as much guidance out as quickly as possible. You just have to remember, this is actually broadly true that Treasury staff is dealing with, the questions exactly like that from people who have questions about the beat, about guilty, about the pass-through provision, about interest, about nonprofit stuff. So they've been triaging all year about which regs they put out when, and they've actually put out a ton of regs, and there's more coming.
And I think that also could, though, create an opportunity for Congress, the next Congress, is as these regs come out, there could be instances where Congress says, well, that's not really what we meant, and they try to clean up some of that stuff. But also could be that as these, and kind of what Kathy was saying earlier, as filers actually start to use some of these provisions, some of these corrections or these modifications or changes will become apparent. That it's one thing to design how an opportunity zone should work in theory, and here's the various ways, and we'll work with Treasury to write some regs. But 2 years from now, when we actually have some experience and we can talk about 199 or BEAT or any of these provisions, there then becomes always this slew of legislation to modify and change based on the experience that filers actually have had with the provisions.
Just looking at that from an individual taxpayer perspective, it's been incredibly challenging to try to anticipate what people's refund size is going to be because we don't know what people's withholdings elections have actually been. And so what's really your point, Nicole, of as people file their taxes and they have this expectation of this is going to be a much simpler filing experience and that, I'm going to get a bigger refund and that my rates are so much lower, when they actually see their personal outcome, I'm sure there will be a lot of feedback to their members. Hey, this is what I thought I was going to get, this is what happened, and help incent some of that change as well.
All the way in the back.
Sonali with Judy Chu's office.
Can you I'm sorry, can you stand up so I can hear you?
Sorry, Sonali with Judy Chu's office. I had a question on the withholding issue. Since it seems like fewer people than probably IRS wanted updated their W-4s, is there any concern that individuals might end up being under withheld and then face a penalty next year? And kind of what are you guys thinking about that?
So you may have noticed that IRS has had a really strong communication campaign around doing the paycheck checkup, and we've been trying to get numbers from them just to even get a sense of how many people have gone to their website to do the the withholding calculator. And while they can't release those numbers, it's clearly much lower than we would expect. So it will absolutely be an issue that people are under withheld. What we're expecting is that for people who have dependents, they're going to see the benefit of the expanded child tax credit and also the expansion of the phase-out ranges there. So, your middle-income families with dependents, we would expect will still be okay. However, as we've mentioned before, people that are getting capped with that SALT deduction at $10,000, and that's your high-income earners, people that itemized, that are in high-income state taxes, that kind of impact is really going to be felt at the moment of realization. And so, our best estimate is that 50% of people are going to be under withheld. We'll see how that actually plays out, it's that's the big question that we're all holding our breath about.
Can I ask a question?
Oh, sure.
Wait, you think 50% of people, because normally the pattern in past years has been 75% of people get refunds, averaging about $2,900. Do you think like 50 this year?
Let me
Okay.
clarify that though.
Yeah.
Because if that's true, like this, yeah,
You found his next story.
Yeah.
But under withheld means they may not get the refund, the same size of refund that they got in the past. So yeah, I'm
Okay.
sorry.
No, it's good. It's good. That's still gonna be an issue. Right.
Good clarification.
So I have a question on the qualified improvement property and other technical corrections. So a lot of people are sort of holding off on some of their investments because of that issue. If that's not dealt with by the end of the year, what are we looking at next year, or sort of time-wise guesstimates for when that can be done, and what might help or hinder that process?
So if I think about all of the technical corrections that were in the Brady bill this week, that is the one that I could see ending up in whatever final package gets passed next week. That is the one that does seem to have some bipartisan support in both chambers. I think members of Congress understand that one needs to be fixed fairly quickly. The challenge that, from an economist point of view, though, is fixing it for 2018 is probably not going to have made much of a difference now. We're now fixing it going forward, right? I think about this in that as you're deciding whether to make an investment, you're doing it based on what how the tax code existed at the time you made that investment. Now, you might have said, all right, I trust Congress. They're going to fix the thing that they messed up. They told me this is what it is, and that might have influenced your investment behavior. But it could well be that there are some folks that held off making those improvements in 2018, and they decide to go ahead and do that in 2019 when there's clarity. In terms of when they would fix that in 2019, if we wait, kind of goes to Rich's point that deadlines matter for Congress. And so you don't see a 2019 deadline, or maybe there's assuming what deal they work out next week on funding, maybe there becomes a funding bill in March when the debt ceiling suspension expires. Maybe you can tie it into there, but it does become difficult. But I think that's the one I'm most optimistic about being in anything next week.
Just to add on to that, we asked Chairman Neal generally, like, what happens if this whole House tax bill falls apart a couple hours ago, and what he said is they would, and this is the exact tension that you're going to run into, which is, he said both, we're going to address this very quickly if nothing happens, because extenders and whatever else, and have deadlines, and then he also said, then we're going to have hearings. So I think that's going to be the tension you have, is where, Democrats have talked a lot about the process problems that they saw in 2017, like the things that drive, they're also going to have the deadline-driven desire to get something quickly. And so you'll see some of that tension come up in January if they've got, if they show up and they haven't done anything. they will be sort of wedged between their interest in having hearings to figure out how this problem happened and what the consequences are, and their desire, as Nicole said, because it's a pretty bipartisan concept, to get this dealt with as quickly as possible.
Should we be assuming that Democrats in the House and Democrats in the Senate are on the same page as far as what they want to accomplish next year? Or is there some tension between House and Senate Democrats on which way to go? And secondly, where do you see the hierarchy of developments coming? Is it Senate Republicans, House Democrats, House Republicans? How would you rank that?
I would not assume that House Democrats and Senate Democrats are going to be on the same page. There always is a bit of tension between the two chambers in general. But no, I think that in particular, the House Democrats are going to be positioned to have a lot of these messaging bills. We're going to have lots of floor votes about raising the top individual income tax rate and repealing step up in basis and, repealing the SALT cap and expanding the EITC. We're going to have a lot of those votes. Senate Democrats have fewer seats next Congress than they do this Congress. They actually could lose a seat on several of these key committees as well. And so I think they'll, in some ways, will be looking to their House counterparts to do some of the messaging work that they can't do. But I think the priorities of you think about the House Democrats on Ways and Means and the Senate Democrats on Finance, I don't know that their priorities are going to be the same.
Yeah.
And then do you see this priority coming from House Democratic leadership or from committee? Like, is it a top-down, or do you think these hearings will drive the conversation?
I think we'll see. I think, it's going to be coming from a few different directions. I think you've got a lot of pent-up stuff that House Democrats who've been here a while want to do. Actually, I haven't done this, but it's a good exercise to go pull up the bills that Ways and Means Democrats have introduced in this Congress and go see what their priorities are. But you've got House Democrats also have this very large freshman class coming in, and I wouldn't discount the impact that they'll have. And it's a freshman class that is in a lot of suburban districts, that is very, if you listen to a lot of them, are very sort of pragmatic sounding and want accomplishments they can rack up. So I would look for those two things, both like the sort of pent up stuff, the sort of frustrations of TCJA, but also kind of to see where some of these new members' ideas come from, because leadership is going to want, and the committee chairs are going to want to be responsive to their majority makers.
Yeah.
Richard, you mentioned, House Democrats are going to want to turn the dial on that corporate rate to pay for some of the things they're after. And I thought I heard you kind of allude to the fact that that was a non-starter. It's interesting because obviously the confluence of provisions in the TCJA that have taxpayers thinking about switching over to being C corporations that hadn't thought about it in 31 years. Is that the sense you get, that moving all 21% to non-starter? Only a few years ago, the 25% rate would have been viewed as a victory, but it sounded like you were pretty confident that that's not going to budge.
So I'm not put this with the caveat of I can't predict things the president will do and not do. You can't, right? It's just a different thing. So, but if you have to talk to Senate Republicans too, and even the president himself obviously ran on 15, right? So he would take 15 and give it to him. I think there's a pretty hard line there. And especially if we start seeing other countries bring their rates, or other, we've seen Canada kind of make some changes on bonus depreciation. I'm sure other countries, the UK is still kind of lowering its rate. So the more you see other countries, if the idea is, Chairman Brady always said, was kind of leapfrog where other countries were, if you start seeing other countries try and come down to where the U.S. is now, that will even sort of stiffen the administration's resolve even further. So, but that said, I wouldn't. It creates an interesting planning issue for companies because it could all change in 2021, right? I think it's immobile for the next 2 years, but it's absolutely a wide open conversation if there's a Democratic president.
Right. very last question, very quickly.
For the honor of having been asked. I know that the Tax Foundation conducted some studies, and have you conducted some studies of the impact of the tax bill on the salt tax? And if so, has it affect the high-end real estate market? Do your information show that it has had a negative impact on the high-end real estate market that subsequently will trickle down to the other levels? So I'd be willing to do it.
Yeah, so we've written, I don't even know how many pieces about the cap on the SALT deduction over the last 2 years. I would say a few things. So one, I think I've made this point to Rich on the phone 100 times. I think the conversation about the SALT deduction has been overblown. Most of the people who are impacted by the SALT cap were AMT filers. So they think they took the SALT deduction because they typed it into TurboTax, they told their H&R Block agent, they did all of those things, and then the computer just threw it aside. But they don't understand that. And so I think most of these people will still actually have net tax cuts because they were AMT filers. They're going to be fine. The numbers, Tax Policy Center actually has great numbers on this. They estimate that only 5% of Americans are seeing a net tax increase this year. And if you think about who those people are, because again, we have the SALT cap, we have the AMT fixes, the expanded child tax credits, lots of these things. The person I actually conceive of is the partner at a multi-state law firm who had SALT filings in 12 states where their law firm had offices. That person, yeah, probably was above the AMT. They probably will be impacted there. But no, we're not. I don't think I don't think we will see impacts on housing because of the SALT cap. I think it's too soon to know that for sure. But I think that this conversation about the SALT deduction has just been well outside the bounds of what it actually meant for most filers.
I think we have seen some impacts because we traffic in more anecdotes than Nicole does sometimes. So I recommend a story that's actually in today's print Wall Street Journal in the Mansion section about high-end real estate in New York City, where one of the reasons people are citing for a slowdown in price growth or people cutting list prices on home sales, and we're talking like $5-7 million real estate, is in fact this cap. So it's having some impact, but it's like that's who we're talking about where it's having an impact. It's not the broader impact. I think is still less clear.
Yeah, one of the, I'll just throw this out there. So we, of course, on our website have a tax calculator where you can figure out your change in liability.
We do too.
But just to put this example, right? So I was actually out with some of my friends, and they were all lamenting, they all live in the District of Columbia, the impact of the SALT cap. And I walked them through, you're probably AMT filers, or you're getting the state child tax credit, like you're gonna be fine. And I actually passed my phone around to all of my friends out at happy hour because I'm that friend, and they all were getting net tax cuts. So again, it's very few people actually saw an increase in their tax liability this year from the Tax Cuts and Jobs Act.
The harshest impact of the SALT cap is the fact that it's not indexed. So it's actually like it's going to pinch people more in 2020 unless people find workarounds. In 23 and 24 than it is in 2018 because it's not indexed and other things in the tax code are indexed more slowly, and the biggest tax cuts people are getting are 18 and 19, and then it starts shrinking after that.
Right. Well, thanks everyone for coming. I want to thank panelists, and also I want to thank H&R Block for sponsoring today's event.
Good to see you guys.